Hi everybody. It's March 24th, roughly about 5:30 Singapore time. I'm here to just give you a very short update on some thinking with respect to the markets. Markets have actually rebounded quite strongly today, despite the fact that Wall Street was down yesterday or last night. The bullishness is carrying through over to European markets. I think there are some signs that we may have moved into what I previously termed as the temporary bottom. I'd like to share some of my thoughts on that with you today. As usual, let me just call up the laser pointer. Okay. If you recap, the last time I mentioned, and this chart was shown in previous videos, that the market initially fell because of the underestimation, that the virus was more like SARS and so on, but actually turns out it's more like H1N1, the seasonal influenza, and even more than that. So this kind of underestimation by the markets, we got the first kind of intervention when the Federal Reserve and the US came out with fiscal policies. Even the WHO introduced a lot of packages and so on for countries. So this kind of first stage optimism from market participants because of the introduction of by authorities of certain financial packages and so on and so forth. But we were not convinced. We argued that the markets had actually continued to underestimate the economic impact from COVID-19. True enough, markets fell. But we also argued that it will reach a point where we call this stage 4, where the markets would actually bottom, a temporary bottom, for a couple of weeks, and then after that may continue on the downside as there are still economic factors, economic conditions, which we feel the markets may have again missed out. But we'll talk about that later. Let's now focus on why we think today may be that turning point potentially. Where markets have bottomed for this temporary bottom. There are two reasons for it, and I'll go through each and every one of them. Sorry. Oops. Yeah. So before that, just having a look at the charts itself, you'll find that the STI in Singapore itself, this is the daily chart. This is today's green bar candlestick, which means that it's gone up. It's a bit hard to see from the daily charts itself, the kind of bottoming process, but when you call up an hourly chart, what you see is that the hourly chart, there's this downward sloping trend line which was actually broken. Apart from that, there seems to be kind of like a base building, a small little inverse head and shoulders here, but I think if I were to mark out this top red line here and the bottom red line here, that would be my kind of guesstimate as to where this consolidation would take place, maybe between 2002 and maybe between 2550 or even 2600. Yeah, so basically between these two, this area itself. Yeah, so right now that seems to be my guesstimate. So the two things, first of all, is I think the markets have more or less discounted COVID-19. I know it sounds a bit surreal, because given the increased death rates and infections and how countries are closing down, shutting down, how can the market actually discount this fully by now? Well, actually the market is forward looking. The market doesn't wait until things happen. Market actually anticipates and discounts it if it has the correct information. This is actually a YouTube video I had the last time. It shows you the chart which I put up, basically suggesting, and this chart was a similar one to what I showed you earlier, and there's this little hump here which I'm going to bring up. That itself is, to me, one of the key indication or indicators as to when the market will bottom. It's not basically 20-30% retracement from the top. It's not basically where PE will be. Has it fallen from 19 to 14, then it will be a good time to buy. No, to me, actually, where markets bottom actually will depend on the case counts, basically, in general. As we move up, and I'm going to show you, as we move up the case count curve, the epidemic curve, so to say, I think markets will become more confident and it will discount the COVID-19 risks. If you remember, China has this epidemic curve, and all epidemic curves are basically what we call bell curves. China's epidemic curve was pretty short and sharp because of some people call it draconian measures that they took. So it was just basically 1.5 months up and then 1.5 months down. And by the end of February, they had actually fully finished the curve. The rest of the world only started to begin the curve a couple of weeks ago when I first showed this chart. And I think today it's roughly about here. The argument is, as we move up the curve, the market knows, because the market is very familiar with this curve now, the market knows that sooner or later we'll hit a peak and sooner or later we'll start coming down from that peak. So there's no need to wait until the peak occurs, and there's no need to wait until the cases decline before the markets bottom. So the markets will bottom ahead of either a peak in the case counts or even a decline in the case counts. So if you look at where the case counts are today, we are roughly about 350,000 worldwide. It's hard to say whether this is 20% or 30% of the total case counts. It is only with hindsight will we know. But I think I'm comfortable to put it that we're probably about 20% maybe, or even up to 1/3 of the way up the epidemic curve. So this number here, the solid line behind here is the actual number of cases globally, while the dotted line is basically the estimated epidemic curve. The chart that you see on the right is basically one which is given by the Financial Times in a report which focused on an Imperial College report. The Imperial College had come out with a report which policymakers took it and actually acted on it. So basically, this report itself suggested that if nothing was done in the UK, up to 500,000 people would actually die. If nothing was done in the US, up to 2.2 million people would potentially die from COVID-19. It spurred the policymakers there to take action, much more stringent action than prior to the report. But the key thing here is basically to look at the curve, and we all know now it's very evident that the curve is one which is a bell-shaped type of curve. The second thing to note actually is the curve actually is estimated, and this is without any controls or without any measures, to peak roughly in maybe June, middle of June, and to end basically in August, okay, or even in late July. So as we can see, it's quite predictable in a sense. As long as the virus doesn't mutate, the end of this first wave is likely to be in between June or early August. Okay, so the market is smart enough to know that even today, if it's here, that sooner or later it will peak and it will come down. So that's why I kind of argue that we don't really have to wait until the case count peaks or come down. The market is smart enough to know that even today we're going to see a peak and a decline very soon in the weeks ahead. The second thing that really is very supportive of the market is the Federal Reserve's actions in recent weeks. First, by cutting interest rates almost to zero, in fact, introducing quantitative easing, and then after that supplementing this with many other measures. I won't go into each and every one of them, just too many measures. And also then after that continuing to come out with additional measures. It's really a shock and awe. All reports that you read, you realize that the analysts are all really in shock with the amount of measures taken by the Federal Reserve. Some of these measures are unprecedented. Some of these measures have appeared in the 2008-2009 crisis, but this time around came in with even more, a higher degree than that was taken in 2008 and 2009. So that goes to show you the Federal Reserve has basically, some people say, thrown the kitchen sink at the market, and even more than that, kitchen sink, washing machine and everything all together. Some of the headlines, as you can see, lending 1 trillion, ramping up bond lending and stuff like that. Okay, this is really epitomizes what the Federal Reserve has done. It took actually 8 months into the 2008 recession before the Federal Reserve actually put through all these actions, and in this particular case, it really just took the Federal Reserve 1 month to throw everything that it took 8 months in the previous crisis. So that goes to show you the eagerness, the willingness of the Federal Reserve to come in a big way, because it does see a lot of economic risks. And really, the markets did freeze up past couple of weeks, especially early March and late February. As you can see from the headlines, especially the high yield markets, you can see the words freeze. Even this chart itself, which is showing you late February, you can see that actually bond sales came virtually to a standstill in late February, and it became much worse in early March. There were even talks that the bankers were pushing the Trump administration to close the markets. It became so bad that they felt that they needed, or they wanted, or their wish was for the markets to actually close in order to stop the carnage that was happening in the financial markets, and especially the credit markets. So putting it all in a chart, basically this is just an updated chart again. The last time I mentioned, when markets come up to here, we are likely to see a consolidation, and that's what I put forth to you earlier on, somewhere between 2002 to 2007, around there. Okay, that's on the STI. This is actually the S&P 500, but basically the pattern should be the same. We should see a consolidation. The big question, of course, is after that, is it business as usual, or is it business unusual? Okay, this short consolidation, or maybe 4 to 6 to 8 weeks, will give opportunities to investors to at least have a breather, because markets came down really in a straight line. So investors will really have to think, what's my next step? Do I think it's business as usual? If it is, do I add on? Do I average down? If I think that it's business unusual, that things are not going to be the same, that markets are going to hit lower, then what do I do? So really, it's a good time to sit down and plan for many individuals, many investors, especially if you got caught on the way down and you're hanging on to a position which now you at least you have some time to think about it. So I would ask you to talk to your financial advisors, sit down and work out a plan how best to approach the next couple of months after this particular consolidation takes hold. If you've liked this episode, please do like our Facebook. I will continue to update some of these ongoings in the markets. So I hope to see you again, and take care.